There is a single, simple sentence that separates the fortunes of the wealthy from the frustrations of the crowd. It is a philosophy so powerful, yet so deceptively plain, that most people hear it, nod, and then immediately ignore it on their path to financial disappointment. It's a rule that, if followed with unwavering discipline, virtually guarantees a level of investment success that the vast majority of market participants will never taste. It is the final promise of a master, a quiet whisper from Omaha that cuts through the deafening noise of Wall Street. And the rule is this: when analyzing a deal, if you have to use a calculator, you should pass. Think about that for a moment. In a world obsessed with complexity, with algorithmic trading, with thousand-page financial reports and spreadsheets that stretch to the digital horizon, the world's most successful investor is telling you to throw it all away. He is telling you that the greatest opportunities for portfolio growth, the ones that truly build generational wealth, are not found by slicing data to the fourth decimal place. They are not unearthed through complex discounted cash flow models with optimistic 5-year growth projections. They are found in plain sight. The truly great investments, the ones that deliver market alpha year after year, should be so blindingly, screamingly obvious that the decision to purchase them requires no intricate calculation. The value should hit you over the head like a sack of gold bricks. This isn't a cute aphorism. It is a weapon. It is a shield. It is the single most effective risk management tool ever devised because it fundamentally changes the game you are playing. The average retail investor, and even many so-called professionals, believes their job is to find reasons to invest. They start with a conclusion: I want to own this stock, and then work backward, building elaborate justifications, tweaking assumptions in their models until the numbers give them the permission they crave. They are talking themselves into a deal. This is the path of the 99%, the road paved with borderline decisions, costly mistakes, and the slow erosion of capital. The master, however, plays a different game. His default answer is always no. His job is not to find reasons to buy. It is to patiently, endlessly, search for the one reason so powerful that saying yes is the only logical response. He is not trying to hit every pitch. He is waiting for the one pitch that is so big, so slow, and so perfectly in the middle of the plate that he can't possibly miss it. This is the principle of the fat pitch, and it is the key to unlocking a level of financial freedom that most people only dream about. By adopting this one simple rule, you stop being a gambler trying to predict the future, and you become a hunter, waiting for the guaranteed prize. You transform your decision-making process from one of hope to one of certainty. You will learn to say no and no and no again for months, sometimes years, until the yes is so obvious it feels like a law of nature. And in that single, decisive moment of action, you will lay a foundation for wealth that is more secure, more powerful, and more lasting than any complex strategy could ever hope to build. This isn't just another investment strategy. It is a complete rewiring of your financial brain, a new way of seeing the world of money, and it is the core secret to consistently and decisively beating the market. To truly understand and implement this profound philosophy, we must deconstruct it into its 5 core pillars. First, we must grasp the foundational concept itself, the philosophy of the overwhelming bargain. This is the bedrock, the mental shift from seeking good deals to demanding obvious ones. Second, we will dissect the great enemy of clarity, the fallacy of precision, and the curse of the spreadsheet, to understand why our most trusted tools are often our greatest betrayers. Third, we will confront the most difficult challenge for any investor, which is cultivating patience and mastering the discipline of the no-swing investor. Fourth, we will build a practical toolkit for identifying the fat pitch, learning how to recognize these rare opportunities when they finally appear. And finally, we will explore the magnificent long-term result of this discipline, the compounding power of no-brainers, and understand how a portfolio built on certainty becomes a true fortress of wealth. This is not just financial education. It is a complete system for superior decision-making, designed for entrepreneurs, investors, and anyone serious about mastering their financial destiny. Let us begin with the first pillar, the very soul of this strategy, the philosophy of the overwhelming bargain. This is more than just buying things cheaply. It is a worldview that demands a colossal gap between price and value. It's the principle that Ben Graham, Warren Buffett's mentor, enshrined as the three most important words in investing: margin of safety. This isn't a small cushion for error. It is a vast, cavernous buffer that protects you from the unpredictable chaos of the world, from recessions, from bad management decisions, from technological disruption, from your own analytical mistakes. You don't buy a business you think is worth $100 for $95. You buy it for $50 or $40 or even $30. At that price, a host of good things can happen. The business can stumble, the economy can turn sour, your own forecasts can be wildly optimistic, and you can still walk away with a profit. The upside becomes explosive, and the downside becomes almost negligible. This is the essence of an obvious, no calculator needed investment. The bargain must be so profound that the outcome is practically predetermined. There is no story that illustrates this pillar more powerfully than Warren Buffett's investment in American Express in the mid-1960s. It is a masterclass in seeing obvious value, where the rest of the market saw only terrifying, unquantifiable risk. The year was 1963, and American Express was a blue-chip institution, a titan of finance synonymous with travelers' checks and credit cards, products built on the bedrock of absolute trust. But that trust was about to be vaporized. A division within American Express had made a series of massive loans to a small, unassuming company in Bayonne, New Jersey, called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino De Angelis. These loans were secured by what was supposed to be a colossal inventory of salad oil stored in giant tanks. But De Angelis was a fraud. He had perfected a simple, brilliant scam. Most of the tanks were filled with seawater, with only a thin layer of valuable salad oil floating on top. When inspectors came, they measured the oil on top and assumed the entire tank was full. The fraud was eventually discovered. Allied Crude Vegetable Oil went bankrupt, and its creditors, including American Express, were left holding the bag for what amounted to over $150 million in today's money. The market reaction was not just negative, it was apocalyptic. Wall Street descended into a state of pure panic. The narrative was simple and terrifying. American Express's business was built on trust, and that trust had been violated. Investors feared that if the company was so incompetent as to be duped by a simple salad oil scam, it might have other, even larger skeletons in its closet. More pressingly, they feared that customers would lose faith in their travelers' checks. If American Express couldn't be trusted to manage its own warehouse lending, how could individuals trust that their travelers' checks would be honored around the world? The stock plummeted, losing nearly 50% of its value in a matter of months. Esteemed financial analysts, the so-called experts, declared that the company's core business was mortally wounded. The situation was filled with uncertainty, fear, and the kind of narrative panic that causes most investors to run for the exits. This is precisely the environment where a calculator becomes useless and a clear, rational mind becomes priceless. While others were trying to model the potential liability, to calculate the exact financial damage and predict the second-order effects on consumer behavior, Buffett did something radically different. He ignored the noise and focused on the simple, observable reality. He didn't build a complex spreadsheet. He went out into the real world. He visited restaurants and banks in his hometown of Omaha. He talked to cashiers, to hotel clerks, to travel agents. He asked them a simple question. Were people still using American Express credit cards and travelers' checks? The answer, universally, was yes. He observed that consumers and merchants made a clear distinction between the parent company's brand, which they still trusted implicitly, and the embarrassing but isolated blunder of a single obscure division. Buffett understood that the American Express brand was a fortress, a powerful moat that the salad oil scandal had failed to breach. He then did some simple, back-of-the-envelope math. He looked at the core earnings power of the credit card and traveler's check businesses. He realized that even after accounting for the full, worst-case scenario losses from the scandal, the company was still earning a tremendous amount of money. The market was pricing the entire company as if its primary business was about to evaporate. In reality, that primary business was humming along just fine. He calculated that the company was trading for around $300 million, while its core, untainted operations were likely worth far, far more. The gap between the panic-driven price and the observable business value was not 5 or 10%, it was a chasm. It was a screaming, obvious bargain. He famously committed 40% of his partnership's capital, a massive bet, to buying American Express stock. He didn't need a calculator to know it was the right decision. The value was self-evident. Within a few years, the stock had multiplied several times over, a foundational investment that helped cement his reputation and build the base of what would become Berkshire Hathaway. This story is the perfect embodiment of the philosophy. While everyone else was paralyzed by fear and trying to precisely calculate an unknowable risk, Buffett focused on the simple, durable, and obvious reality of the underlying business. That is the essence of demanding an overwhelming bargain. The psychological principle that underpins this philosophy is a powerful antidote to two of the most destructive cognitive biases in finance, the overconfidence bias and its close cousin, the Dunning-Kruger effect. Overconfidence bias is the simple, universal human tendency to believe we are smarter and more capable than we actually are. We overestimate our ability to predict the future, to forecast earnings, and to understand complex systems. The Dunning-Kruger effect is a more specific manifestation of this, where people with low ability at a task overestimate their ability the most. In investing, this is a lethal combination. The amateur retail investor, armed with a few online articles and a trading app, often feels a sense of mastery that is completely disconnected from their actual knowledge. They believe they can predict the next hot tech stock or time the market's swings. The demand for a no-calculator bargain short-circuits this entire psychological trap. It is an act of profound intellectual humility. When you insist on buying a dollar for 50 cents, you are implicitly admitting that you don't know the future. You are building a system that allows you to be right, even when you are wrong. Let's say you value a business at $100 per share, and you buy it at 50. Perhaps your valuation is off. Maybe the company faces an unexpected headwind, and it turns out the business is only worth $80 per share. Because of your enormous margin of safety, you still stand to make a 60% profit. The speculator who bought it at $95, confident in their precise valuation, is now sitting on a significant loss. Your demand for an overwhelming bargain is a structural defense against your own fallibility. It acknowledges that the world is chaotic and unpredictable, and that your own analysis is imperfect. It forces you to operate only in areas where the odds are so overwhelmingly skewed in your favor that the specifics of the future become secondary. This is a crucial element of professional-grade risk management. It's not about being smarter than everyone else. It's about having a system that protects you from your own stupidity and the market's insanity. So how do we translate this into a practical, repeatable process? The applied mental model for this pillar is what I call the back-of-the-envelope valuation test. It's a simple, three-step process designed to quickly determine if an investment opportunity even deserves a moment of your serious consideration. This is your first-pass filter, the gatekeeper that protects your time and capital from borderline ideas. Step 1 is the liquidation value sanity check. Before you look at earnings or growth prospects, look at the company's balance sheet. What would happen if the company went out of business tomorrow and sold off all its assets? Look at the hard assets: cash, real estate, inventory. Could you buy the entire company today for less than the value of its tangible assets after paying off all its debts? This was the classic cigar butt investing of Ben Graham, While less common today, these opportunities still appear during market crashes and panics. If you can find a company trading for less than its net cash on the balance sheet, the value is so obvious it requires no calculator. You are essentially getting the entire operating business for free. Step 2 is the 10-year earnings power test. Forget complex multi-stage growth models. Ask a simpler, more powerful question. If this business were to earn, on average, roughly what it has earned for the past few years for the next 10 years, with no heroic growth, what would my return be at today's price? This is a much more conservative and realistic question. You can often do this in your head. If a stable company earns $2 per share and is trading at $10, you are getting a 20% pre-tax earnings yield. That's an obvious bargain, a fat pitch. You don't need to project that earnings will grow at 15% a year to justify the purchase. The current, observable reality is good enough. This forces you to focus on the demonstrated durable profitability of a business, not on speculative future growth. It's a core tenet of simple investing that protects you from the siren song of story stocks. Step 3, and perhaps the most important, is the what has to go right inversion test. Instead of listing all the reasons the investment will succeed, force yourself to list the absolute minimum number of things that must go right for this not to be a disaster. For a truly great investment, the answer should be almost nothing. For the American Express investment, Buffett just needed the core brand to survive. He didn't need it to grow explosively. He didn't need management to be brilliant. He just needed the world to keep using travelers' checks. Compare this to a speculative biotech stock. For that investment to work, the clinical trial must succeed. The FDA must grant approval, the marketing team must execute flawlessly, and competitors must not develop a better drug. The list of things that must go right is a mile long. The back-of-the-envelope test forces you to find situations where the path to a reasonable return is short, simple, and paved with observable facts, not hopeful projections. This mental model is the practical application of demanding an overwhelming bargain. To fully appreciate the power of this approach, we must examine its opposite, the antithesis, or the path of the 99%. This is the path of the hope and a prayer speculator. This individual doesn't invest, they gamble. They are drawn to companies with exciting stories but no tangible value. They buy stocks in industries they don't understand, often with companies that have never earned a profit, based on the hope that some future event, a new product, a paradigm shift, a buyout, will make them rich. Their decision-making is driven by narrative and emotion, not by financial analysis. They see a stock price going up, and, driven by FOMO, they pile in, assuming the trend will continue forever. They are not buying a piece of a business. They are buying a lottery ticket. They don't seek a margin of safety. They embrace a margin of hope. When you ask them why they own a particular stock, they won't tell you about its durable competitive advantage or its pristine balance sheet. They'll tell you about a revolutionary technology or a visionary CEO. They are buying a story, and more often than not, that story has an unhappy ending. The financial graveyards are littered with the stocks of companies that were supposed to change the world but never managed to make a dollar. The speculator's portfolio is a testament to the dangers of ignoring the principle of the overwhelming bargain. Finally, let's trace the direct financial connection. How does this philosophy manifest in tangible financial outcomes? The demand for a massive margin of safety has two profound effects on a portfolio. First, it acts as the ultimate form of capital preservation and risk management. When you buy assets for far less than they are worth, you are building a fortress around your principal. The single biggest destroyer of long-term wealth is the permanent loss of capital. A 50% loss requires a 100% gain just to get back to even. By avoiding these catastrophic drawdowns, you allow the engine of compounding to work its magic uninterrupted. A portfolio built on overwhelming bargains is inherently more stable and resilient. It may not capture every last bit of upside in a roaring bull market, but it will protect you from the devastating crashes that wipe out the speculators. This defensive quality is the unsung hero of long-term portfolio growth. Second, It creates a powerful, asymmetric return profile. When you buy at a 50% discount to intrinsic value, your potential downside might be 10 or 20% if you're wrong, but your potential upside could be 100% or more as the price reverts to its true value. You are consistently making bets where the potential reward vastly outweighs the potential risk. Over time, making a series of these asymmetric bets is how true fortunes are built. It's not about hitting home runs every time. It's about playing a game where the odds are so heavily stacked in your favor that you are almost guaranteed to win over the long run. This isn't just a philosophy, it's a mathematical certainty. The direct financial connection is clear. A large margin of safety protects your downside and magnifies your upside, creating the optimal conditions for sustainable, long-term wealth creation and the achievement of financial freedom. This first pillar is the foundation upon which all successful value investing is built. Now we must confront the great villain of this story, the seductive tool that leads countless well-intentioned investors astray. This brings us to our second pillar, the fallacy of precision and the curse of the spreadsheet. In our modern, data-driven world, we have been conditioned to believe that more information and more complex analysis lead to better decisions. The spreadsheet, with its infinite cells and powerful formulas, has become the high church of financial analysis. It offers us a sense of control, an illusion of scientific certainty in an inherently uncertain world. We build elaborate discounted cash flow models, projecting revenues, margins, and capital expenditures out for a decade or more, and then we discount them back to the present to arrive at a precise intrinsic value, often calculated to 2 decimal places. This process feels rigorous, it feels smart, and it is one of the most dangerous things a retail investor can do. The core problem is this: a spreadsheet is not a tool for discovering truth, it is a tool for manufacturing justification. The output of any financial model is entirely dependent on the assumptions you put into it, and those assumptions are nothing more than educated guesses about an unknowable future. Do you think the company will grow at 8% per year or 10%? Will its margins be 20% or 22%? These seemingly small tweaks can lead to wildly different valuation outcomes. The spreadsheet gives you a precise number, like $142.37, which feels objective and real, but that number is built on a foundation of subjective guesses. This is the fallacy of precision, mistaking a precisely calculated number for an accurately known fact. The danger is that we fall in love with our own creation. We spend hours building the model, and we become psychologically committed to its conclusion. The spreadsheet transforms from a tool of inquiry into a machine for confirming our own biases. The perfect anecdote to illustrate the limitations of spreadsheet-driven analysis and the superiority of qualitative judgment comes from one of the most important acquisitions in Berkshire Hathaway's history, the purchase of See's Candies in 1972. At this point in his career, Buffett was still heavily influenced by his mentor, Ben Graham. He was a cigar-butt investor, looking for statistically cheap companies, often mediocre businesses trading at bargain basement prices. He was a man who loved quantifiable data, balance sheets, earnings statements, and the hard numbers. See's Candies was not that kind of investment. It was a high-quality, family-owned California chocolatier. When it came up for sale, Buffett and his partner, Charlie Munger, took a look. By the numbers, the deal was borderline at best. The sellers were asking for $25 million, a price that was more than 3 times its book value and represented a significant premium to its tangible assets. For the old Buffett, the calculator Buffett, this was a non-starter. A spreadsheet analysis would have been unflattering. You would have had to make some very optimistic assumptions about future growth to make the $25 million price tag look reasonable. Buffett was on the verge of walking away. It was a classic calculator problem. The numbers didn't scream obvious bargain. But Charlie Munger saw something else. He saw a value that could not be captured in a spreadsheet cell. He saw the power of the See's Candies brand. He understood that See's wasn't just selling chocolate, it was selling nostalgia, tradition, and quality. Customers had a deep emotional connection to the brand. They would happily pay a premium price for See's chocolates for holidays and special occasions, and they wouldn't even consider a competitor. This gave C's immense pricing power. They could raise their prices year after year to cover inflation and then some. And their loyal customers wouldn't flinch. This brand loyalty was a powerful, intangible asset, a moat around the business that protected it from competition. Munger argued forcefully that they should be willing to pay a premium for a truly wonderful business with a durable competitive advantage. This was a radical departure from the Graham style of buying mediocre businesses at dirt-cheap prices. Munger eventually convinced Buffett to pay the $25 million. It was a pivotal moment in Buffett's evolution as an investor. He later said that C's Candies taught him the importance of paying up for quality. The investment has since generated over $2 billion in pre-tax earnings for Berkshire, a return of more than 80-fold on their initial investment, and it continues to be a cash-generating machine. A purely quantitative, spreadsheet-driven analysis would have missed this spectacular opportunity. The true value of C's wasn't in its physical assets. It was in the minds of its customers. This story perfectly highlights the curse of the spreadsheet. It excels at measuring the tangible but is completely blind to the intangible qualities that often create the most long-term value. It teaches us that sometimes the most important variables in an investment decision can't be put into a formula. True market alpha often comes from understanding the qualitative factors that the number crunchers ignore. The psychological principles at play here are confirmation bias and the illusion of control. Confirmation bias is our natural tendency to search for, interpret, and recall information in a way that confirms our pre-existing beliefs. If you are initially excited about a stock, you will subconsciously build your spreadsheet model in a way that validates that excitement. You'll choose slightly higher growth rates, slightly lower discount rates, and you will arrive at the buy conclusion you wanted from the beginning. The spreadsheet becomes an echo chamber for your own optimism. It's a highly sophisticated form of talking yourself into a deal. The illusion of control is the tendency for people to overestimate their ability to control events. A detailed, multi-tabbed financial model gives us a profound sense of control over the future. By modeling out a decade of performance, we feel as though we have tamed uncertainty. We believe we have charted a clear path for the company's future. This is, of course, a complete fantasy. The world is a chaotic place. New competitors emerge, consumer tastes change, recessions happen. The spreadsheet cannot account for this inherent randomness. It gives us a false sense of security, leading us to take risks we otherwise wouldn't. The no calculator rule is a direct assault on these two biases. It forces you to step away from the seductive comfort of a detailed model and demands that the investment thesis be so robust that it holds up without the need for manufactured precision. It's a critical component of a sound investment strategy because it grounds your decision-making in reality, not in a digital fantasy. To put this into practice, we can use an applied mental model I call the pre-mortem spreadsheet analysis. This is an inversion of the typical process. Before you are even allowed to open Excel or Google Sheets, you must perform a pre-mortem. You take a piece of paper and you write at the top, "1 year from today, this investment has been a complete disaster. We lost 50% of our money." Then you must write down at least 5 plausible reasons why this happened. Was it a new competitor? A change in technology? A recession that hit their customers harder than expected? Did management make a terrible capital allocation decision? This exercise forces you to confront the bearish case first. It systematically fights confirmation bias by making you argue against your own initial enthusiasm before you've become emotionally invested in a spreadsheet model. Only after you have thoroughly explored the potential for failure are you allowed to open the spreadsheet. And when you do, your primary goal is not to see how good things can get, but to stress test the assumptions you just identified in your pre-mortem. What happens to the valuation if revenue growth is negative for 2 years? What if margins get cut in half? This transforms the spreadsheet from a tool of justification into a tool of destruction. You are actively trying to break the investment thesis. If the investment still looks attractive even under these pessimistic, stress-tested scenarios, then you might have something truly special. But most of the time, you'll find that the investment's attractiveness is highly fragile and dependent on an optimistic future that is far from guaranteed. This mental model reclaims the spreadsheet as a tool for risk management, not a machine for wishful thinking. The opposite of this prudent approach is the antithesis, the path of the 99%, embodied by the quant or the modeler. This person has fallen in love with complexity. They believe that their superior analytical skills and more sophisticated models give them an edge. Their spreadsheets are works of art, with intricate formulas, macros, and sensitivity analyses. They spend more time building and tweaking their models than they do thinking about the actual business. They can tell you the projected free cash flow in the third quarter of 2031, but they can't tell you why a customer chooses that company's product over a competitor's. They suffer from physics envy, trying to apply the precise laws of science to the messy psychological world of business and markets. They believe the map is the territory. The great irony is that their pursuit of precision often leads to bigger mistakes. Because they are so confident in their detailed models, they fail to demand a sufficient margin of safety. They are comfortable buying a stock they value at $100 for $95 because their model is that good. When the unpredictable reality of the world inevitably deviates from their spreadsheet forecast, they have no buffer to protect them. Their complexity becomes a source of fragility, not strength. This is a path many intelligent and hardworking people follow, but it is a path that often leads to ruin. The direct financial connection here is stark and quantifiable. Let's look at how small changes in assumptions can have a massive impact on a company's valuation, revealing the financial fragility of precision. Imagine you are valuing a company. You build a discounted cash flow model. You assume the company will grow its free cash flow at 8% per year for the next 10 years. Your model spits out an intrinsic value of $100 per share. The stock is trading at 90, so it looks like a decent, if not overwhelming, bargain. But what if your growth assumption is just slightly too optimistic? What if the real growth rate turns out to be 6%? That 2 percentage point difference seems trivial. But when you plug 6% into your model, the new intrinsic value is not $90, it might be $75. Your bargain has suddenly vanished and turned into an overpayment. Now consider the reverse. What if you were hoping to buy the stock and needed to justify it? It would be incredibly easy to nudge that growth assumption from 8% to 10%. That change might get your valuation up to $120, making the $90 stock price look like a fantastic deal. This is how easily the spreadsheet can be manipulated to tell you what you want to hear. The no calculator rule protects you from this financial self-deception. It forces you to find opportunities where the value is so compelling that it holds true across a wide range of possible futures, not just one precisely modeled optimistic scenario. It replaces fragile, precise calculations with robust, approximate certainties, which is the key to superior, long-term portfolio growth. Having established the need for an overwhelming bargain and the dangers of false precision, we arrive at the most challenging pillar of all. It is the one that requires not intellectual brilliance, but emotional fortitude. This is Pillar 3, cultivating patience, the discipline of the no-swing investor. Warren Buffett famously used a baseball analogy to describe his investment style. He said that in investing, you stand at the plate, and the pitcher, Mr. Market, throws pitches at you all day long. In baseball, if you don't swing at 3 good pitches, you're out. But in investing, there are no called strikes. You can stand at the plate for days, weeks, months, or even years, watching thousands of pitches go by, and you suffer no penalty. You can wait for that one perfect pitch, that fat pitch that is right in your sweet spot, and only then do you swing with all your might. This is an incredibly powerful idea, but it is profoundly unnatural. Every fiber of our being, shaped by millions of years of evolution, screams at us to do something. Our brains are wired with an action bias. When faced with a problem or an opportunity, our instinct is to act. Sitting still feels like laziness, like missed opportunity. This is amplified 1,000 times over in the world of finance. We are bombarded with a constant stream of news, price charts flashing green and red, and pundits breathlessly proclaiming the next big thing. The entire financial media ecosystem is designed to encourage activity, to make you feel that if you aren't trading, you are falling behind. This creates a powerful fear of missing out, or FOMO, that is the enemy of rational decision-making. The discipline to stand at the plate and not swing, day after day, while others are hitting what look like home runs, is perhaps the rarest and most valuable skill in all of investing. It requires a level of patience and emotional control that few possess. But it is the absolute prerequisite for implementing a no-calculator strategy. You cannot wait for the obvious bargain if you are not psychologically prepared to do nothing for very long periods of time. The most legendary demonstration of this discipline in Buffett's career was his conduct during the dot-com bubble of the late 1990s. It was a period of mass hysteria, a new paradigm where the old rules of valuation were declared dead. Technology companies with no earnings and often no revenue were soaring to astronomical valuations. Investors who had practiced prudent value investing for decades were being left in the dust. The pressure on Buffett was immense. He was publicly ridiculed. Magazine covers declared him a dinosaur, an old man who just didn't get it. His performance lagged the soaring Nasdaq index by a staggering margin. For several years, he looked like a fool. His own shareholders at the annual Berkshire Hathaway meeting grew restless, questioning why he was sitting on a mountain of cash while seemingly everyone else was getting rich overnight on stocks like Pets.com. Buffett's response was simple and unwavering. He admitted he didn't understand these new businesses. He couldn't project their earnings 10 or 20 years into the future with any degree of certainty. He couldn't identify their durable competitive advantages. The pitches being thrown were fast, erratic, and way outside his circle of competence. So he didn't swing. He patiently watched pitch after pitch go by, refusing to participate in a game he didn't understand, even as the crowd booed him for his inaction. This was not a passive act. It was an active and incredibly difficult decision, a triumph of discipline over ego and emotion. He was willing to look foolish in the short term to avoid being proven foolish in the long term. And then, in March of 2000, the bubble burst. The Nasdaq crashed, losing nearly 80% of its value over the next 2 years. The high-flying tech darlings of yesterday were wiped out. Trillions of dollars of speculative wealth vanished. And Warren Buffett, the dinosaur, was revealed to be the Noah of the financial world, having safely kept his investors' capital on the ark while the floodwaters washed away the gamblers. His patience had not just protected his shareholders from catastrophic losses, it had also armed him with a massive pile of cash at the precise moment when bargains began to appear everywhere. The dot-com bust is the ultimate parable of the no-swing investor. It proves that the periods of inaction, the moments when you choose to do nothing, are often the most critical and profitable decisions an investor can make. It is a testament to the idea that true wealth management is as much about the mistakes you avoid as the brilliant investments you make. The underlying psychological principles that make this patience so difficult are action bias and the previously mentioned fear of missing out, FOMO. Action bias is the ingrained human tendency to favor action over inaction, even when inaction is the more rational course. In primitive times, this was a survival trait. If you heard a rustle in the bushes, it was better to run, action, than to sit and analyze the situation, inaction. But in the modern world of investing, this instinct is a liability. The market rewards deliberation and patience, not frantic activity. FOMO is a social phenomenon amplified by our hyper-connected world. We see others posting about their gains in cryptocurrencies or meme stocks, and we feel a powerful social pressure to join in, lest we be left behind. This emotional response overrides our rational brain, causing us to chase hot trends and buy assets at inflated prices, often right before they crash. Cultivating the discipline to not swing is an act of rebellion against these deep-seated psychological triggers. It requires you to consciously decouple your self-worth from your short-term investment performance. It demands that you find satisfaction in the process of patient waiting, not in the thrill of constant trading. It is a mental game, and the opponent is your own primal brain. Winning this game is a prerequisite for achieving long-term financial freedom. So how do we develop this superhuman patience? The applied mental model for this pillar is the investment note card discipline. It's a powerful exercise in clarity and commitment, popularized by Buffett himself. The rule is simple. Before you buy any stock, you must be able to write down your entire investment thesis on a single 5x7 note card. You should be able to explain, in simple language, what the business does, what its durable competitive advantage is, why you believe it's undervalued, and what the major risks are. If your thesis is too complicated to fit on a single note card, it's not a fat pitch. It's not an obvious no calculator needed idea. This exercise does two things. First, it forces you to distill your thinking down to its essential elements. It cuts through jargon and complexity and demands a simple, powerful core idea. This is the first step in identifying a true no-brainer. Second, and more importantly for this pillar, it dramatically raises the bar for what qualifies as an investment worth your time and capital. Because the process of creating a clear, concise note card requires real thought and research, you won't be tempted to do it for every fleeting idea that crosses your screen. It acts as a powerful filter, forcing you to ignore the constant noise and focus only on the few opportunities that are truly compelling enough to warrant this level of focused effort. This discipline naturally cultivates patience. You stop chasing every pitch because you have a system that demands you only prepare to swing at the ones that are truly worth the effort of creating a note card. It turns patience from a passive act of waiting into an active process of disciplined filtering. The antithesis to this patient approach is the path of the 99%, perfectly personified by the hyperactive trader. This individual is an adrenaline junkie, addicted to the action of the market. They are constantly checking their portfolio, watching financial news, and looking for the next trade. Their decision-making is driven by short-term price movements, chart patterns, and breaking news headlines. They buy a stock on Monday because of a positive earnings report and sell it on Wednesday because of a rumor about a new competitor. They mistake activity for progress. They believe that by trading more, they are being more diligent and will achieve better results. The reality is the exact opposite. The hyperactive trader is their own worst enemy. They are systematically transferring their wealth to two groups: their brokers, through a constant stream of commissions and fees, and the government, through short-term capital gains taxes. More importantly, they are constantly whipsawed by the market's random emotional swings, buying high in moments of euphoria and selling low in moments of panic. They are always swinging, and as a result, they frequently strike out. Their portfolio is not a tool for long-term wealth building. It's a vehicle for expensive entertainment. This frantic, undisciplined approach is the polar opposite of the patient, deliberate, no-swing investor, and it is the reason why the vast majority of active traders fail to beat the market over time. The direct financial connection of cultivating patience is one of the most powerful forces in finance, the reduction of frictional costs and the maximization of compounding. Let's quantify this. Imagine two investors, both starting with $100,000 and earning a respectable 12% annual return before costs. The hyperactive trader trades their entire portfolio once a year. They might pay 1% in commissions and fees, and because all their gains are short-term, they pay a 35% tax rate on their profits. The patient, no-swing investor buys a handful of great companies and holds them for decades. Their transaction costs are virtually zero, and they pay a much lower long-term capital gains tax rate of 15%, and only when they eventually sell. After 30 years, the results are not just different, they are in different universes. The hyperactive trader's portfolio, eroded by the constant friction of costs and taxes, would grow to approximately $1,100,000. A fantastic result by most standards. However, the patient investor's portfolio, allowed to compound with minimal friction, would grow to nearly $3 million. That is a difference of $1.9 million. The patient investor's wealth is almost 3 times larger, not because they were a better stock picker, but simply because they had the discipline to do nothing. This is the staggering financial power of patience. Every decision to not trade, to not incur a cost, to not trigger a tax, is a direct contribution to your long-term wealth. It is the silent, invisible force that turns a good investment strategy into a life-changing one. It is the engine of true portfolio growth. We have now established the philosophy of the overwhelming bargain, warned against the siren call of the spreadsheet, and embraced the discipline of patience. The logical next question is, if we are patiently waiting for these obvious no-calculator opportunities, how do we actually recognize them? This brings us to our fourth pillar, the practical application of the entire system, identifying the fat pitch, a practical framework for recognizing obvious value. Throwing away your calculator and your complex models does not mean throwing away analysis. It means shifting your focus from complex speculative forecasting to the simple, diligent observation of present realities. A fat pitch is an investment opportunity where the value is not hidden in a financial model, but is lying in plain sight for anyone willing to do some basic, common-sense investigation. These opportunities are rare, but they are unmistakable when they appear. They typically fall into a few recognizable categories, and learning to spot these patterns is a key skill for any successful retail investor. The definitive story of identifying a fat pitch through simple, observational analysis is Buffett's investment in the Washington Post in 1973. At the time, the stock market was in a deep bear market. Investor sentiment was abysmal. The Washington Post Company, a venerable institution, saw its stock price pummeled along with everything else. The entire company had a market capitalization of just $80 million. To most investors, it was just another stock going down. But Buffett, ever the patient hunter, began to do some simple, no-calculator-needed analysis. He didn't build a complex model to project the future of the newspaper industry. Instead, he looked at the company's assets as they existed right then and there. He asked a simple question: what does this company own? The answer was astounding. The Washington Post Company owned the newspaper itself, which was a dominant, profitable franchise in a major city. But it also owned several other highly valuable assets. It owned Newsweek magazine. It owned several network-affiliated television stations in major markets like Miami and Hartford. And it owned a significant amount of valuable real estate. Buffett, using his knowledge of media properties, did a quick, back-of-the-envelope valuation of just the television stations. He concluded that the TV stations alone were worth at least $100 million, probably more. Think about that. You could buy the entire company for $80 million, and in theory, sell off just the TV stations for $100 million, leaving you with the newspaper, the magazine, and all the other assets for free, plus $20 million in cash. This is the definition of a fat pitch. The value was not a matter of opinion or speculation. It was a matter of simple arithmetic. The sum of the parts was demonstrably, overwhelmingly greater than the current market price of the whole. The market, in its state of panic and depression, was completely mispricing the company. Buffett didn't need a spreadsheet to figure this out. He needed a basic understanding of business, the ability to read a financial statement, and the intellectual clarity to see what was obviously there. He began buying the stock aggressively, eventually investing over $10 million, a significant sum for him at the time. That investment in the Washington Post would go on to be one of his most successful ever, compounding at a staggering rate for decades and returning more than 100 times his initial investment. It is the quintessential example of how a fat pitch is identified not through complex calculation, but through the simple recognition of glaring, quantifiable value that the rest of the market, blinded by emotion, has overlooked. The psychological principle that allows us to spot these opportunities is the deliberate use of the recognition heuristic and the avoidance of the availability heuristic. The availability heuristic is a mental shortcut that relies on immediate examples that come to mind when evaluating a specific topic. In investing, this means we tend to focus on companies that are always in the news, the exciting tech giants, the controversial story stocks. These are available in our minds, but they are also the most analyzed and often most efficiently priced stocks in the market. Fat pitches are rarely found here. The recognition heuristic, in contrast, can be a powerful tool when used correctly. It suggests that we often make good decisions by choosing the option we recognize. Buffett's version of this is his famous circle of competence. He invests only in simple, understandable businesses. He looks for companies like Coca-Cola, See's Candies, or The Washington Post, businesses whose products and competitive advantages are easy to grasp. When a simple, recognizable business that you understand is trading at a price that makes no sense based on its observable reality, that's often the signal of a fat pitch. The key is to combine recognition with a rigorous, value-oriented filter. You aren't just buying what you know, you are waiting for what you know to become incredibly cheap. This approach narrows your focus to a manageable universe of potential investments and allows you to develop deep knowledge, making it easier to spot the truly glaring mispricings when they occur. To turn this into a repeatable process, we can use the scuttlebutt checklist as our applied mental model. The term scuttlebutt was popularized by the legendary investor Philip Fisher, and it refers to the process of gathering qualitative, on-the-ground information about a business that you can't find in an annual report. This is how you confirm that what looks like a fat pitch on paper is a fat pitch in reality. This checklist is your blueprint for this investigative work. First, become a customer. If it's a retail or consumer products company, use their products. Experience the brand firsthand. Is it a superior experience? Why do people choose this product over others? This is what Buffett did with American Express. Second, talk to customers. Ask them why they use the company's services. How loyal are they? Would they switch to a competitor for a small discount? This helps you understand the strength of the company's brand and its pricing power. Third, investigate the competition. Use their products as well. What are they doing better or worse? This helps you understand the company's competitive landscape and its moat. Fourth, if possible, talk to employees or ex-employees. Websites like Glassdoor can be a treasure trove of information about company culture and morale. A happy, motivated workforce is often a leading indicator of a healthy business. Fifth, talk to suppliers. Are they treated well? Does the company pay its bills on time? This can give you insights into the operational efficiency and financial health of the business. The Scuttlebutt Checklist is a framework for gathering real-world evidence. It's about moving beyond the numbers and understanding the business as a living, breathing entity. It's this deep, qualitative understanding that allows you to swing with conviction when a fat pitch finally comes your way, because you have a level of knowledge that the spreadsheet jockeys simply cannot replicate. This is a crucial skill for any serious entrepreneur or investor engaged in high-level decision-making. The antithesis of this diligent, investigative approach is the path of the 99%, followed by the tip chaser. This individual's investment process begins and ends with a piece of secondhand information. They hear a stock tip from a friend at a barbecue, see a recommendation from a pundit on television, or read a bullish post on a social media forum. They treat this tip as gospel and immediately buy the stock without doing a single moment of independent research. They are essentially outsourcing their most important financial decisions to complete strangers with unknown motives and unverified track records. They don't understand the business they are buying, they don't know what a fair price is, and they have no idea what the risks are. Because they have no foundation for their belief in the investment, they are susceptible to every rumor and price swing. When the stock goes down, they panic and sell, because they have no underlying conviction to hold on. The tip chaser is playing a game of financial Russian roulette, and it is a game they are almost certain to lose over the long term. This abdication of personal responsibility is the fastest path to financial ruin. So what is the direct financial connection of being able to identify a fat pitch? It is the ability to locate and acquire what I call balance sheet alpha. This is a source of market-beating returns that comes not from predicting the future, but from exploiting discrepancies in the present. In the case of the Washington Post, the fat pitch was right there on the balance sheet and the list of assets. The market value of the company was $80 million, but the tangible, separable, and conservatively valued assets were worth well over $100 million. That $20 million plus gap was pure alpha, a risk-free return waiting to be captured. When you identify a fat pitch, you are often buying assets for significantly less than their replacement cost or their private market value. You are finding situations where the stock market, in its short-term emotionalism, has created a massive gap between price and hard, quantifiable value. Your portfolio's performance becomes less dependent on the whims of the economy or the stock market and more dependent on the simple, inevitable closing of that value gap. This is a much more reliable path to portfolio growth. By learning to read financial statements and think like a business owner, you can systematically uncover these opportunities. You stop playing the market's guessing game and start playing the investor's valuation game, a game where the odds are firmly on your side. We have now journeyed through the core tenets of this powerful philosophy. We have committed to only buying overwhelming bargains, rejected the false comfort of spreadsheets, cultivated the deep patience required to wait for opportunity, and learned the practical skills to identify a fat pitch when it arrives. This brings us to our fifth and final pillar, the culmination of all this effort, the compounding power of no-brainers, building a fortress portfolio. This is where we see the long-term, life-altering impact of this investment strategy. A portfolio constructed using these principles behaves very differently from the average person's collection of stocks. It is not a speculative vehicle, it is a fortress. It is designed first and foremost for survival and second, for relentless, almost inevitable growth. The secret to this power lies in one simple, mathematical truth. The avoidance of large errors is a more powerful driver of long-term returns than the pursuit of spectacular winners. Charlie Munger famously said, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent." This is the essence of the Fortress portfolio. The entire no-calculator philosophy is a system designed to prevent you from doing stupid things. By insisting on an overwhelming bargain, you avoid overpaying. By shunning complex models, you avoid fooling yourself with optimistic projections. By practicing patience, you avoid chasing fads and panicking in crashes. And by focusing on fat pitches, you avoid speculating on businesses you don't understand. Each pillar is a layer of defense against the most common and destructive investment errors. When you consistently avoid these big mistakes, something magical happens. You allow the eighth wonder of the world, compound interest, to work its magic on your capital base, uninterrupted by the catastrophic setbacks that plague most investors. The perfect anecdote to illustrate the compounding power that flows from a single, obvious, no-brainer decision is Buffett's investment in the Coca-Cola Company in 1988. This was not a small, obscure company he found by digging through financial filings. This was one of the most famous and well-known brands on the entire planet. The fat pitch here was not one of hidden assets, but of a temporary dislocation between perception and reality. The market had just suffered the Black Monday crash of October 1987, and investor sentiment was still fragile. Coca-Cola stock, along with the rest of the market, had been hit. Furthermore, the company was still living down the public relations disaster of New Coke from a few years earlier. Some analysts felt its best growth days were behind it. Buffett, however, saw a different reality. He saw a business of unbelievable quality available at a reasonable, if not dirt-cheap price. He didn't need a calculator to see the power of the Coca-Cola brand. It was a global juggernaut, a simple product that billions of people around the world consumed every single day. The company had a massive distribution network that was virtually impossible to replicate. It was a royalty on the thirst of humanity. He saw that the company could raise its prices slightly each year, and its unit sales would continue to grow as developing nations became wealthier. It was a simple, predictable, cash-generating machine. and due to the market's temporary pessimism, he was able to buy it at a price that offered a very attractive earnings yield. He invested over $1 billion, acquiring a stake that represented more than a quarter of Berkshire Hathaway's portfolio at the time. It was a massive, concentrated bet on a single no-brainer idea. He wasn't trying to make a quick 50%. He was buying a wonderful business that he intended to hold forever. That one decision, that single swing at a fat pitch, has been a cornerstone of Berkshire's success. The initial $1 billion investment has grown to be worth over $25 billion today, not including the tens of billions in dividends that Coca-Cola has paid to Berkshire over the years. This is the ultimate demonstration of the pillar's power. By identifying one obvious, high-quality business at a fair price and having the patience to hold it for the long term, Buffett created a tidal wave of wealth that has compounded for decades. It shows that you don't need hundreds of good ideas to get rich. You only need a handful of great ones, and the discipline to let them work for you. The psychological principle that a fortress portfolio helps you master is the management of loss aversion. Behavioral economists have shown that for most people, the pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. A $10,000 loss hurts far more than a $10,000 gain feels good. This deep-seated bias is what causes investors to make their biggest mistakes. When the market crashes and their portfolio is down 30%, the pain becomes unbearable, and they sell at the absolute bottom, locking in their losses. Then, when the market recovers, they are too scared to get back in and miss the entire rebound. A fortress portfolio, built on a foundation of no-brainer investments, bought with a large margin of safety, is psychologically easier to hold during these terrifying periods. Because you bought your stocks at such a significant discount to their intrinsic value, you have a deep, rational conviction that they will eventually recover. You know you own good businesses at great prices. This conviction allows you to override the primal fear driven by loss aversion. It gives you the strength to hold on during the storm, and even better, to be a buyer when others are panicking. Mastering this psychological aspect of risk management is a key differentiator between amateur and professional investors. The applied mental model for building this fortress is the fortress balance sheet filter. Before you even consider the valuation or the business quality of a company, you must first ensure it is financially indestructible. This is a simple, non-negotiable filter that will immediately eliminate 95% of all public companies and dramatically reduce your risk of making a catastrophic error. There are 3 simple checks. First, look at the debt. Does the company have a manageable amount of debt relative to its earnings? A simple rule of thumb is to look for companies whose total debt is less than 3 or 4 times their annual pre-tax earnings. Companies with enormous debt loads are fragile. A small hiccup in their business can quickly lead to a financial crisis. Second, check for consistent positive free cash flow. Free cash flow is the actual cash profit the business generates that can be used to pay dividends, buy back stock, or reinvest in the business. A company that consistently gushes cash is a strong company. Avoid businesses that are constantly burning through cash and need to raise more money from investors just to survive. Third, look for a history of rational capital allocation. Does the management team have a track record of using that free cash flow intelligently? Do they reinvest it in high-return projects, buy back stock when it's cheap, or do they squander it on overpriced, ego-driven acquisitions? A quick look at a company's financial history can tell you whether you are partnering with smart capital allocators or reckless empire builders. Applying this simple fortress balance sheet filter ensures that you are only fishing in the pond of high-quality, resilient businesses. It is the first and most important step in constructing a portfolio that can withstand any economic storm. The antithesis of this careful construction is the path of the 99%, which leads to the creation of a portfolio by the diversifier. This is the investor who has heard that diversification is important but misunderstands what it means. They believe that owning hundreds of different stocks will protect them. So they buy a little bit of everything, dozens or even hundreds of stocks, often through a collection of mutual funds and ETFs they don't truly understand. The problem is that they have diversified away their knowledge. They know nothing about the vast majority of the businesses they own. This is not diversification, it is diversification. It leads to guaranteed mediocrity at best and disaster at worst, because hidden within their sprawling portfolio are often many low-quality, over-leveraged, and overpriced companies. They think they are safe, but they have simply created a cluttered, unfocused collection of assets that is likely to perform no better than a simple index fund. After fees. True diversification is not about how many things you own. It's about owning a handful of high-quality, uncorrelated assets that you understand deeply. The fortress builder focuses on the quality of their holdings, not the quantity. Finally, the direct financial connection of this pillar is the mathematical inevitability of avoiding large drawdowns. Let's make this brutally clear with simple math. If you have a $100,000 portfolio and it suffers a 50% loss, you are left with $50,000. To get back to your starting point of $100,000, you now need to achieve a 100% return on your remaining capital. A huge, difficult task. Now consider an investor who, through the principles of the fortress portfolio, manages to limit their loss in the same crash to just 15%. Their portfolio drops to $85,000. To get back to $100,000, they only need to make a return of about 17.6%. A much easier and more probable task. Over multiple market cycles, the investor who avoids the big loss will inevitably end up far, far ahead of the one who suffers large drawdowns, even if the latter achieves higher returns in the good years. The long-term trajectory of your portfolio is determined more by the depth of your worst losses than the height of your best gains. Building a fortress portfolio of no-brainers is a direct, systematic strategy to control those losses. It is the most reliable and stress-free path to beating the market and achieving true, lasting financial freedom. It is the ultimate payoff for adopting the simple, powerful rule of throwing away your calculator. You have just been given a powerful weapon, a mental tool that cuts through the noise, the complexity, and the emotional traps that sabotage the financial lives of most people. You now possess the single most powerful filter used by the world's greatest investor. The discipline to only act when the opportunity is so obvious, so overwhelming, that it requires no complex justification. You've learned to demand a massive margin of safety, to see the spreadsheet as a potential enemy, to cultivate the profound power of patience, to identify the rare, fat pitch, and to build a fortress portfolio designed for relentless compounding. This is not just theory, this is a blueprint for a lifetime of superior decision-making. But this filter, this commitment to only swinging at the fat pitch, is just one pillar in a larger architecture of thought. It is a profoundly powerful rule that tells you when to swing. But it doesn't tell you how to identify the pitcher. It doesn't tell you how to understand the fundamental rules of the game being played, or how to analyze the condition of the playing field itself. It's one critical component in a network of interconnected mental models that, when combined, create a complete system for seeing the world of business and finance with absolute clarity. The video that YouTube is about to show you on your screen is the next critical piece of that architecture. It is the bridge connecting the what to the why. It is the link that explains how the very structure of the market, the psychological tides of fear and greed that sweep through Wall Street, are what create these fat pitches in the first place. Understanding this next piece is the difference between being a technician who can follow a rule and being a master who understands the entire game. You have invested your most valuable asset, your time, to learn this tool. Most people will stop here, satisfied with this single piece of wisdom. But for those of you who are serious, for those who see this not as a hobby but as the foundational work for your financial future, the journey continues. The path to mastery requires building a complete mental arsenal. The next piece of that arsenal is now in front of you. Fulfill the promise you made to yourself when you started this video. Continue your ascent. Complete the next step in your financial education. click the video on your screen.